Hello everyone. Today I am here to explain the concept from the chapter Admission of Partner. The topic I have chosen for discussion is adjustment of capital. I would first like to give a small description on the learning outcome of the chapter. We will learn about admission of partner, how to calculate new profit sharing ratio, then learn to calculate sacrificing ratio. Next, we would also learn the treatment of goodwill as per Accounting Standard 26, treatment of reserves, accumulated profit and accumulated loss in case of admission of a partner. Then learn how to prepare revaluation account where we would be revaluing assets and do reassessment of liabilities. At last, the final thing to be learned in this chapter is how to adjust the capital of partners on reconstitution of partnership. In this chapter, you would be coming across with certain keywords or certain new terms. I would like to highlight those terms: sacrificing ratio, revaluation account, premium for goodwill. To begin my explanation, let us first know what is adjustment of capital. In case of admission of a partner, adjustment of capital means either new partner will contribute as capital an amount in proportion to his share of profit, or that the capital of other partners will be adjusted to make them proportionate to their respective share of profit. So we shall discuss adjustment of capital under two conditions. Condition number 1, adjustment of old partners' capital on the basis of new partners' capital. Condition number 2, calculate the capital of incoming partner on the basis of old partners' capital. Point to be noted, incoming partner is also known as new partner. Today I will discuss case 1 of adjustment of capital, that is how to adjust old partners' capital on the basis of new partner capital. To proceed with this topic, I have taken help of CBSE board question. Now very precisely, I will explain the question followed by solution. The question states that there is a balance sheet of W&R given as on 31st March 2010 with the profit sharing ratio between W and R as 3:2, and the values of liabilities and assets are given in the question. And on admission of B on this date, the following conditions were followed. Point number 1, B will get share in profit equal to 4/15th. We will bring capital equal to 30,000, and on the basis of B's capital, the other partner's capital would be adjusted. In point number 3, it has been mentioned that B would bring his share of goodwill for cash, and the goodwill will be valued on the basis of average profit of past 4 years, and number of years of purchase would be 2.5 years. Point number 4 states that on the day of admission of a partner, the assets were revalued and there were certain changes with the asset sundry debtor, stock and plant and machinery. The last point, that is point number 5, states that the profit of the firm for previous 3 years, 2007, 2008 and 2009, were 20,000, 14,000 and 17,000 respectively. And a very important point to see, that is the profit for the present year 2010 year end is inside the balance sheet, that is 15,000 on the liability side. Profit and loss account is equal to 15,000. To begin with the solution, we need to do certain working notes. So first, the working note which we would do is calculation of goodwill. So the goodwill will be calculated on the basis of average profit, and thus the formula of goodwill calculation is equal to average profit into number of years of purchase. Average profit of 4 years equal to 16,500, and if multiplied with the number of years of purchase, that is 2.5 years, the value of goodwill comes as 41,250. While taking the profit figures of 4 years, we need to be careful for the last year's profit, because the last year's profit is not appearing in our question as additional information. It is appearing inside the balance sheet 15,000 amount. The next working note would be calculation of new ratio, because on admission of a partner, the new partner, that is B, is getting admitted. So on his admission, the old profit sharing ratio would change, and we have to derive the new profit sharing ratio among W, R and B. So to calculate the new profit sharing ratio, we will assume that the total share of the profit be X or is equal to 1. B's share, as mentioned in question, is 4 by 15th. So the remaining partner share from 1, if 4 by 15 is of B, then the remaining partner share comes as 1 minus 4 by 15, which is equal to 11 by 15. This remaining share 11 by 15 will be shared by the old partner W and R in their profit sharing ratio. Thus, the new share of W comes as 11 by 15 into 3 by 5. 3 by 5 is the old share of W, which is equal to 33 by 75. Similarly, for R, the new share comes as remaining share 11 by 15 into his old share 2 by 5, which is equal to 22 by 75. So to find out the new ratio among W, R and B, we have to make sure that the share of B, which is 4 by 15, is converted into the equal denominator, as we can see for W and R, which is 75. So to make it equal to 75, the denominator, we need to multiply 4 by 15 share, we need to multiply this fraction with 5 by 5, which is equal to 20 by 75. Thus the new ratio comes as 33 is to 22 is to 20. The third working note which we will do is calculation of sacrificing ratio. So what is sacrificing ratio? Sacrificing ratio is the ratio in which the all partners sacrifice their portion of share of profit in favor of the incoming partner. So thus here B is the incoming partner and W and R would be sharing their share of profit with B. So we need to find out that what is the sacrificing ratio between W and R in favor of B when they have given the share to B. So sacrificing ratio's formula is equal to old ratio minus new ratio. Thus, if we calculate the sacrificing share of W, we get it as 3 by 5, the old share of W minus the new share of W, 33 by 75, which is equal to 12 by 75. Same way for R, old share minus his new share is equal to 8 by 75. And for B, he didn't had any old share, so it is 0 minus his new share 20 by 75, which comes as minus 20 by 75. Thus, the share which is coming as negative figure indicates that this partner has gained the share from the other partners W and R. So if we check that W's portion sacrificed is equal to 12 by 75 and R's portion sacrificed is equal to 8 by 75. So if we sum this up, this sacrificed share of W and R, it comes as 20 by 75, which is equal to the portion which B has gained. Thus, the sacrificing ratio between W and R is equal to 12 is to 8. If further simplified, it comes as 3 is to 2. The next working note is working note for adjustment of capital of all partners. In this adjustment, we will first find out what is the total capital of the firm, and based on the total capital of the firm, the capital of the partners W, R and B would be adjusted. As we know, B's share is 4 by 15th and B's capital contribution is 30,000. We would make use of these two informations to find out first the total capital of the firm. So total capital of the firm is equal to B's capital into reciprocal of B's share, which is equal to 1,12,500. The total capital of the firm will be distributed among W, R and B in the new profit sharing ratio. So if we distribute this in the new profit sharing ratio, 33 is to 22 is to 20. Then the following figure comes for W, that is 49,500, W share of capital. R share of capital comes as 33,000 and B share of capital comes as 30,000. This balances will be carried forward in the partner's capital account as balance sheet because these are the closing balances of the partners in the partnership firm. Next, we would do now working note number 5, where we will learn how to find out the share of B's goodwill which B would bring and compensate to the sacrificing partner W and R in sacrificing ratio. As we have valued the goodwill of the firm as 41,250 in our previous working note number 1, we'll take up this value and find out B's share in this goodwill. So B's share is 4 by 15th in goodwill 41,250, which comes as 11,000. So 11,000 amount would be brought by B to compensate the sacrificing partners for sharing their share of profit in favor of B. So the journal entry which would be passed on bringing the goodwill is cash to premium for goodwill account. So premium for goodwill account would be credited, and next the premium for goodwill would be transferred to W's capital and R's capital in their sacrificing ratio, which we have calculated in working note number 3. Sacrificing ratio 3 is to 2. So the amount which W would get is equal to 6,600 and R would get 4,400. The working notes done in different parts would be utilized in our further question. Now we will proceed towards the main solution. This main solution will begin with preparation of revaluation account. Revaluation account's nature is nominal account, and the revaluation account is prepared to ascertain the profit or loss on revaluation of assets and reassessment of liabilities. So in our question we can see point number 4, which gives us the additional information that assets were revalued. So we will refer those information for making the revaluation account. Point number 4 states that sundry debtors at book value less 5% provision for doubtful debt. So if we see our balance sheet which is given in the question, we can see sundry debtors gross value is 20,000 and less provision is 700. Now we need to revalue. We have to take 5% less as provision for bad debt. So 5% on 20,000 comes as 1,000. We can see that the provision for bad debt is no more 700. It has reached to 1,000. So that means there is a further increase of provision by 300 rupees. So we can say that this provision increase 300 will reduce our sundry debtor value further by 300. So there is decrease in sundry debtor by rupees 300. So the decrease in assets are debited in revaluation account. So here sundry debtor has been debited by 300. Stock new value is 20,000. Let us check what is the old value of stock in balance sheet. It is 25,000. So stock value has reduced by 5,000. The decrease in stock has been debited in revaluation account by 5,000. Plant and machinery's new value as given in additional information is 40,000. And the balance sheet figure shows that plant and machinery was 35,000. It indicates that the value of plant and machinery has increased by 5,000. So increase in assets are credited in revaluation account. So we have credited revaluation account by plant and machinery 5,000. On closing the revaluation account, we see that we get a loss of rupees 300 because our debit side has come more than our credit side. Debit side sundry debtor plus stock comes as 5,300, whereas in credit side there is only one increase in asset by 5,000. So the difference comes as 300 rupees, which is revaluation loss. So this revaluation loss is to be transferred to partners' capital in their profit sharing ratio, which is also loss sharing ratio. W shares out of 300 180 rupees and R would share 120 rupees as the loss. The next thing we will make is partners capital account. So partners capital account would be a combined capital account of all the partners W, R and B. To begin with partners capital account, we would make use of the opening balance of capital which is appearing in the question inside the balance sheet. W's capital 40,000 and R's capital 30,000. So this would be the balance BD for the partners capital account. So on the credit side, as it is a liability, so the opening balance will be credited. So on the credit side, we would post for W 40,000 and for R 30,000. Next, the goodwill which the incoming partner has bought to compensate the sacrificing partner W and R would be transferred into their capital account by premium for goodwill account 6,600 for W and for R 4,400. The figures we have got from the working note number 5. Next, the partner B, new partner, he has brought 30,000 rupees as his share of capital. So the capital account of partner B would be credited by cash rupees 30,000. On finishing the posting of these aspects, now you would refer revaluation account to check whether we have profit or loss on revaluation. So in the given solution, we found out that we have got revaluation loss 300 rupees and which got transferred among partners capital W 180 and R 120 because this loss will be shared only by old partners and not new partner. So the loss 180 and 120 got debited to the old partners capital. Thus, all partners W and R, their capital accounts has been debited by revaluation account 180 and 120. Now, refer the balance sheet as given in question liability side. In liability side, we will check whether we have any accumulated profit or reserve because those items also need to be transferred to all partners capital. So here we can see that in the balance sheet there is accumulated profit because profit and loss amount appearing in the liability side is 15,000. So this 15,000 would get distributed among the partners in their profit sharing ratio 3:2. Thus, the capital accounts of W and R got credited by profit and loss 9,000, 6,000. 9,000 plus 6,000 is equal to 15,000, which matches with our balance given in question. Next, we would post the balance CD from our working note because in this question already we have found out the closing balance of capital for the partners W, R and B in working note number 4. So from working note number 4, you would post the closing balances of the partner into the debit side of partner's capital account. For W 49,500, for R 33,000 and for B 30,000. On finishing this posting, now we are supposed to do the total of debit side and credit side. So the total of debit side and credit side should be equal. On doing the totaling, we see that there is a balancing figure appearing into the debit side of W 5,920 and similarly for R also a balancing figure appears into the debit side as 7,280. This indicates that the capital of W and R on the credit side is greater than the debit side. Thus, this amount is the extra capital of W and R which is lying in the business. So, this amounts W and R would be withdrawing from business. Thus, if they withdraw this amount, then their capital gets debited and the posting is done as to cash. So these figures are balancing figure which got calculated when we were closing our partner capital account. The last account to be closed is the column of B. So if we close the column of B, we can see only one entry in the column of B on the credit side, that is 30,000 capital which B has bought. So the debit side will be also equal to 30,000 as given in the balance CD. So thus for column B or for partner B, we don't have any balancing figure because the capital which B has bought, it becomes the closing capital for that partner B. At last, we are supposed to make the balance sheet of the firm after reconstitution has taken place as on 31st March 2010. While making balance sheet, we need to be careful as assets and liabilities will be shown at their revalued or reassessed figures, and the capital account will comprise of all the partners including the new partner B. To make balance sheet, we will refer revaluation account and partners capital account. While making balance sheet, we will refer the old balance sheet which is given in the question. To start with, we will refer first the liability side of the balance sheet, that is the creditors. We can see it is appearing at the value 20,000 in our old balance sheet, and now while preparing the new balance sheet, creditors would appear at the same value 20,000 because creditors value did not change on admission of a partner. As in question, we can see for creditor no information has been given. Next, we can see the item profit and loss account appeared on the liability side 15,000. But this item will not come in new balance sheet as this profit and loss already got distributed among partners in their old profit sharing ratio among W and R in their partners capital account. The third item which we can see in our liability side is capital accounts. In the question, the balance sheet shows capital account of only old partners W and R. But when we are making the balance sheet of the new firm that is on B's admission, we have to include B also into the capital account while writing the capitals of the partner. Thus, for writing the balances of capital for all the partners W, R and B, we will refer the balance CD of partners capital account, which we can see it is the last item appearing on the debit side of partners capital account. W 49,500, R 33,000, B 30,000. So the total capital of the new firm is equal to 1,12,500. This also we can cross-check with our working note number 4, where we have ascertained the total capital of the firm 1,12,500 on the basis of new partners share and new partners capital contributed by B. On this, our liability side gets over, and if we sum it up, it comes as the total 1,32,500. Coming to the asset side, we will refer the question again, and the balance sheet shows that cash balance on 31st March before admitting the new partner was 5,000. So we will refer the 5,000 and do some adjustment with cash because on admission of the partner B, he brought some amount of capital. He also brought his share of goodwill to compensate the sacrificing partners. Thus, the amount which he has bought will be added to the opening balance 5,000 of cash. So 5,000 plus 11,000 plus 30,000. This is the total amount which firm has for cash. But in balance sheet, we also have to adjust this cash with the amount which the old partners W and R have withdrawn because their capitals were showing a surplus balance in the partners capital account. So the amount withdrawn by W and R, that is 5,920 and 7,280 will be withdrawn, which will be subtracted from the cash available. Thus, the net amount we can see for cash appears as 32,800. This is an important point because cash need to be adjusted. The money which comes in from the partner, incoming partner, will increase the cash balance, and the money which the old partners are withdrawing from the business, their capital, it will reduce the cash balance. Next, the item which we can see in asset side is sundry debtor, gross value 20,000 and less provision 700. But in this particular item, we can see that information was there that for sundry debtor, the provision would be 5% less. So when we have calculated 5% on 20,000 value, it comes as 1,000 rupees. That means the provision for sundry debtor increased from 700 to 1,000. So there was a net increase of 300 rupees into the provision. Thus, the sundry debtor now would appear in our new balance sheet as per the new condition, that is 20,000 less provision 1,000 instead of 700, which was the old figure. So the net amount for sundry debtor is 19,000. The third item appearing in balance sheet in our question is stock 25,000, but the value of stock as per the additional information got changed. Stock on revaluation was found to be 20,000 on admission of the partner P. Thus, we will show stock at rupees 20,000. The fourth item is plant and machinery in our question, which is equal to 35,000. And again, point number 4 of additional information states that plant and machinery's new value is 40,000. Thus, we'll show plant and machinery at 40,000 instead of showing it at book value 35,000, which is appearing in our question. The last item of asset side is patent 20,700. Patent will appear at the same value 20,700 in new balance sheet also, because no further information regarding the change in the value of patent has been mentioned in the question. On finishing the posting on the asset side, now we will sum up the figures of the asset side. The total sum comes as 1,32,500. On summing up the assets and liabilities side, we can see that the total of assets is equal to total of liabilities, which states that our balance sheet is correct. At the end, I would like to conclude stating that in this chapter, admission of a partner, we have learned how to calculate new ratio among the partners. We have also learned how to calculate sacrificing ratio, then did the treatment for goodwill, that is the portion of share of goodwill which the incoming partner brings got transferred to the partner's capital account, who sacrificed their share of profit in favor of the new partner. We also learned how to prepare revaluation account and determine either profit or loss on revaluation, which gets distributed among all partners in case of admission of a partner. We also learned how to prepare partner's capital account including the new partner. In the same account, we also learned how to adjust the old partner's capital account on the basis of new partner's capital account. And at last, we learned to show assets and liabilities in the new balance sheet at revalued values, which we have completed in the balance sheet. Thus, this question helped us to learn the various aspects and accounting treatments to be done in case of admission of a partner into the partnership business.